Hey guys, this is Abby Finance here. Thanks for tuning in. Today we're just going to do a quick recap of how the market has been behaving this week. So at the end of last week, there was a big sell-off in the tech sector, and that actually caused the retail sector to kind of compensate, and there was a bit of a sector rotation, right? So from out of tech stocks into financials, meaning big banks and other financial institutions. Energy companies started to improve, ExxonMobil and Chevron, some of the big names in the oil and energy space. But also what hasn't been talked about in the news media so much has been that retail stocks actually picked up last week. So Under Armour shot up from about $20 per share to up around $23 per share. Yeah, they actually closed just below $23 per share today. So as you can tell here, the performance over the past week has been very positive, and that's actually caused me to gain about $255 on Under Armour in just the past week alone. So that's really helped bring our portfolio up, along with Target, which has performed quite strongly over the past week, up about $2.50 per share. So that's been up about $110 over the past week. So we've had some strong performers here over the past week or so. And our main loser in our portfolio at this point was still Fitbit. And I think Fitbit is going to have to be a company that we either ride out for the next 5 to 10 years, and we basically hope that they keep selling a few million devices each year and they slowly become valued more, because they're no longer going to be the quick growth company like we saw in the beginning, right? They unfoundedly went public at about $30 per share, shot up to about $47, almost $50 a share right after they went public. So they're now trading for about a sixth to even a ninth of the price that they once were, Fitbit is. So while we believe that, it's really hard to look at negative $330, we lost about 24% of our initial investment on Fitbit at this point. Honestly, I don't think that they can really get much lower. They're almost selling for their book value. They're almost selling for just tangible assets at this point. And I think that the Fitbit brand is valuable. While it's no Apple and they can't compete with the Apple Watch in terms of technology and advancement and what Apple is doing, I do think that there is a niche market for Fitbit, and I kind of think that there always will be. So while our Target investment is nearly back to even, we're down about $80, which is significantly less than the $250 that we were down for a while. And our Under Armour investment has actually turned positive of late. We do believe that we want to hold Target and Under Armour for the long term. With Fitbit, it's a lot harder to say how long our holding period will be for Fitbit, given that they're not paying out any dividends, so that does not make them comparable to Target. And they don't have the same breadth of product or breadth of customers that Under Armour has. So it's a lot harder to be a shareholder of Fitbit, given that the risk is high, their returns are low, and they're actually started turning a loss each quarter, which is surprising given that they had been profitable for, the first 3 to 4 quarters that they had been reporting earnings as a public company. So yeah, all of a sudden Fitbit is not looking like our best investment. It's definitely an investment I wish I hadn't made. I definitely overpaid for it, and I didn't really think about the strength of the business as much as I thought about just customer loyalty. I like the Fitbit product. And then I actually went ahead and bought an Apple Watch, and I haven't really touched my Fitbit since, and I think that may continue to happen across the board. So, well, I'm not saying sell all your Fitbit shares if you have them. I'm just saying that I don't think Fitbit will necessarily be a staple in our portfolio in, who knows, maybe 20, 30 years from now. But I think if we ride out Fitbit, it might be interesting to see what types of returns they can provide in the future. There's a chance that they could be acquired by a larger technology company. There's a chance that they could reinvent themselves as a service company, a health company. And there's a chance that they could just keep going along steady at about $1.5 billion to $2 billion in sales per year, maybe incrementally growing that each year as customers renew their devices, maybe they start subscribing to some of the services, and some of the corporate wellness programs do pick up. So while Fitbit is not going to be a 20-30% revenue growth company per year, we do feel that it's safe enough to hold on to for now, and it's definitely just a stock that we're going to be monitoring in the future. So it's a quick recap of the end of last week in the market and into this week. So tech was down again yesterday, and they actually popped back a little bit today, but we're really hoping to see an extended sell-off in the tech sector. In particular, there's one company that we feel like we missed. So Apple is a company that I told all my friends to buy. You know, if anybody had any money, they would have been buying right around $90 a share. I don't think Apple will ever see this price again, to be honest with you guys. So I was monitoring the company, you know, throughout the end of last year into the beginning of 2016. And I saw their price go under 100, and I knew that they were a clear buy, but I just didn't have the capital to go ahead and purchase any shares. So, you know, I'd really like to see Apple decline back to about 125. And Facebook, you know, who knows what price they could drop to. They've basically been on a straight march upward all year long. So at one point they were at 133 and they dropped to 115, $18 decline. They were as high as 154. So to use $18 there, you know, if they got down to about 136, about 136, maybe 130, they could be in buying range again for us on Facebook. I think that the big tech stocks, you know, FANG, Facebook, Apple, Amazon, Netflix, Google, even Microsoft should be thrown in there. I think that it's a stronger name than some of these other companies I just named. I'd really like to see a pullback on the tech prices because it's a sector that I'm extremely underweight in my portfolio. I recently just picked up Intel Corporation, Qualcomm, and Cisco, which are really strong very financially strong technology companies. So they have a nice fat balance sheet with lots of cash. They're increasing revenues each year, and they're pretty well safe investments, as is a Microsoft, as is an Apple, as is a Google, as is an Amazon, as is an Oracle, as is Alibaba, IBM. So these are all really great tech names that I really want to own. I just have a very hard time valuing these companies because their revenue is growing so quickly, and their price to earnings multiple for the most part is higher than I would like to pay on a lot of these companies. So it's a big challenge for me to, you know, set a price target in my own mind of where I want to buy it at. You know, for me, I really like to buy on a big price decline. So as we look here at Microsoft over the past 5 years, there's really been very little to no negative news coming out about the company to cause the share price to decline. Its biggest price decline was maybe from about 54 to 48, or 45, 46 down to about 38. Yeah, I'd say in percentages it was 46 to 38. So if I had been buying back in 2014, 2015, this little decline right here would have been a perfect opportunity. But as you can see here over the past year, there's literally no opportunities that would have jumped out at me where I should be buying the stock. Every time you look, they're making a new jump up, a new jump up, and a new jump up before it ever comes back down to earth. 46% return over 1 year. I just can't imagine them keeping this pace up. I think that the price needs to revert back to their mean or their average. So I'm really hoping I could see something closer to, if not $40, $55 a share out of Microsoft. It'll be extremely challenging for the market to really take so much valuation out of Microsoft, given that they've run so much since the summer of last year. But if I were to buy into Microsoft, I would really be hoping that they're closer to between $45, $50, $55 a share nowadays. And right now, I'm seeing them up over 70, and they were once as high as 72, almost 73. So, you know, I'm really expecting a bigger decline here on these prices before I get into Microsoft, or any other tech stock for that matter. So I know I ranted today. I kind of went off on a tangent. I discussed the end of last week's market conditions, the beginning of this week's market conditions. I also covered some of the sector rotation that we've been seeing, how retail is picking up of late. Tech has been dropping off a little bit. I did cover a lot today, but I think as I'm making videos a bit less frequently, I might as well have some longer videos out there for you guys who are interested in learning more and hearing more about my thoughts on the stock market. So thanks for checking in. This is Abby Finance here. Please leave a like, comment, or subscribe if you haven't yet. And thanks for checking our video out. Have a good one.